You're listening to RealAgriculture.com. Get real, get connected.
Okay, so we're here at the Canadian Forage and Grasslands Association Conference, joined by JP Gervais, and you were giving us an update on the markets essentially. So, what's the 2016 year looking like?
Well, we try to break it down by sectors, and if you think of the sectors that are connected to forages and grassland and hay, I thought of cattle, dairy, and as well as just talk about the feed markets in general, and just because that's competing against some of the products that are sold by the people in attendance here today. So, look at the cattle outlook. Remains extremely positive. 2015 is still going to be a great year. 2016, if you look at cow-calf operations, they're still going to expected to turn a profit that is going to be bigger than average if you look at the last 15 years, say. So the outlook remains extremely positive for cattle producers. Now, if you look at producers that are finishing animals, then it's a little bit tighter, especially when it comes to feedlots, for example. They're seeing some margins that are not maybe borderline negative. It's projected to increase in 2016 as we have calf prices that are coming down. But I think one of the challenges, if there's one, would be that beef prices are starting to come down a little bit. Now, beef supply in the United States is still a market very much driven by the United States. Beef supply in the United States is up because of two things. We have fewer animals to slaughter, but yet beef supply is up, and that's the result of more imports of live animals in the United States because of a strong U.S. dollar. It makes sense for them to import more animals, as well as marketing weights that are up significantly, and that's been a trend ongoing for a number of years. And so with weights up, more animals that are bringing in the country, so that means that beef supply is up. With supply is up, prices are coming down, so it brings a little bit of pressure on profit margins, and so that's something to keep an eye on. I don't think it's going to turn negative anyways anytime soon, but nevertheless, I think we'd expect prices to come down a little bit. And so when you look at livestock or cattle receipts, 2015 is still going to be a great year, perhaps not as good as 2014, but with the Canadian dollar expected to remain low into 2016, I think cattle receipts on the revenue side of things, that top line for cattle producers is still going to be very good as a result of the different, the number of things. One is good demand for beef, a low Canadian dollar, and demand domestically as well as in foreign markets. That's one of the things that I emphasize today is the outlook, the long-term outlook is positive, mainly because of increasing demand for beef and animal proteins in general. So overall, a pretty good outlook.
And you're talking about the U.S. herd basically increasing, but Canada's is going down still.
Still going down, not slightly down, I would say, but not showing any signs of going up. And then so what we know is, and what we observed over the last 12 months would be that, some producers are expanding. But if you look at the aggregate or the situation at the industry level, because some producers are expanding, some producers are getting out. And so at the aggregate level, you still have beef numbers that are coming down, whereas in the United States, heifer retention's up, and so you can clearly see that the inventory numbers are up, and actually 2 successive semesters of inventories going up in the United States, which suggests that they're slowly rebuilding now. So they're jumping ahead of the next cattle cycle, compared to Canada, because we're still in a declining phase, yet slightly declining, but still declining. So there's something to be thinking about, right, for the future of the industry. I think because the conditions are right. Low Canadian dollar, interest rates remain extremely low. Projected to remain low into 2016. So, it could be a good time to invest in the cattle industry right now.
Should we be excited about the Trans-Pacific Partnership, especially when we think about MCOOL still dragging on?
Right. So, absolutely. I think, for the beef sector, it's TPP or Trans-Pacific Partnership opens up a lot of different opportunities. It remains to be seen when this is going to be ratified, and we still have to hear from the federal government about how they're going to approach this trade deal. But from what we know and the details that have transpired since the 12 countries reached an agreement, we could see markets open up for Canadian beef in Asian markets, and we're talking about here Japan, and then some of the future growth markets like Vietnam and Malaysia. Now, the one thing that is interesting is, given that we just said, given country of origin labeling, it raises a number of questions. Are we going to be exporting, let's just say that we get more market access, but the United States is also going to get more market access. So is the United States going to export more meat, and we're going to be exporting live animals to the U.S.? or are we going to be also exporting more beef and meat? So, and part of the answer, I suppose, is whether or not 2 3 years down the road, because TPP is just way down the road. 2 3 years down the road, are we still going to have country of origin labeling with us? And is that going to be finally repealed? That's the big question mark around that. And so that's something that we'll have to just wait and see, I suppose.
I guess we can use the TPP as a springboard into the dairy sector because we know that there's some animosity there for sure. How's dairy looking into 2016?
Well, in this entire discussion around Trans-Pacific Partnership and dairy, I believe that the biggest challenge for the dairy sector is actually not related to TPP. And one of the challenges for the dairy sector is the profitability has been trending down over the last 12 months. And that's actually, I think there's a good reason why, not necessarily good, but there's definitely a reason why. That's because of demand for butter is up, so we have to produce more milk. And then producing more milk, we have an increase in production of butter fat and solids non-fat. And usually we use butter fat in the butter, and I'm simplifying things here, and we use solids non-fat into production of cheese, yogurt, and so on. What happens now is that we have imports of proteins that are coming in the U.S. without being taxed at the border, and that's because of previous trade deals that have been signed. And so there's not a whole lot that we can do about that. And so these proteins are displacing solids non-fat into lower value markets, for example, animal feed, and that tends to bring the price that dairy producers get lower. And that's what happened over the last 12 months, as well as, not a whole lot of people know this, but as much as 20% of all milk in Canada can be priced at world price levels. And we know that the world prices for dairy products have been really low lately. So all of that considered, I think that what is the biggest challenge right now is how do you face that declining trend in profitability, declining profit margins that historically have always been stable for dairy producers. And so I think that's one thing that the industry is looking at right now, because what they're thinking about is developing a dairy ingredient strategy to sort of prevent imports of proteins coming into Canada. And also I think there's a bit of relief on the horizon, especially in the eastern part of the country where producers should get a bit of relief on the feed cost side of things because of a good hay crop in eastern Canada. So not necessarily the same situation in western Canada, but nevertheless I think there's a bit of relief in the horizon for producers located in the eastern part of the country.
So let's talk about those differences in hay and feed availability. Where are we at with feed at the end of this year and going into next?
Well, in terms of feed costs, I think if you look at feed grains, I would not expect feed costs when it comes to feed grains to go up. I mean, inventories, stocks are rebuilding, whether it's in the United States and the world level, acres are going up, and when they're not going up, yields are going up. So unless we have, barring any major supply disruptions, and a lot of people are focusing on El Nino now, and for good reasons. I think it has the potential to disrupt the markets that we know quite a bit. Not an expert though, and so I wouldn't venture a guess as to what will be the impact if we do get a stronger El Nino this time around. But barring any major weather disruptions, I do think that we're still likely to face slightly declining feed costs when it comes to feed grains. Now the hay situation is a little bit different. We do have prices that have skyrocketed in Western Canada, and so that puts a little bit of pressure on some producers that have to rely on the marketplace to get their supply of feed. Otherwise, I think feed costs are slightly trending down for most sectors.
Mm-hmm. The feed cost is interesting because it seems like a lot of producers are hanging on to August feed costs. They're trying to sell feed or
right.
hay specifically
Sure.
for August prices when actually it's maybe we have more than enough.
Absolutely, yes, and then the market should actually correct it to reach that equilibrium point, and producers maybe are holding out and I'm going to find out later on that maybe the wisest move would have been to actually sell at that time, and time will tell if marketing was the strategy, which marketing strategies were right forward.
You left us with a bit of a question at the end of your presentation. Should we be putting more energy essentially into international markets for hay and forage? What would you say?
Oh, I think we should. We're a reliable premier supplier of hay products in the international market. Well, part of my message was that I don't think we can rely on a low Canadian dollar to establish a presence in foreign markets. What matters long term are a couple of things. First of all, the growth in demand that we're facing for our products. So that is a function of income growth in other countries, so GDP, gross domestic product. And we think that emerging markets are doing well in that sense. Another thing that matters a great deal is innovation and productivity. We've been able to successfully export in foreign markets because of our emphasis on productivity and innovation. So we need not to fall in that low Canadian dollar trap and say, well, everything's going to be great now because I'm going to be competitive given that our currency has lost value. Well, our currency has lost value against the US dollar, but so has many other commodities. And so it's not necessarily automatic to say that, oh, low Canadian dollar gives us a really great competitive advantage in foreign markets. It does in some instances, but you have to be careful not to fall in that trap of say everything's going to be all right. We just need to continue investing in productivity and innovation.
Okay, thank you so much.
Hey, it's a pleasure.